Welcome to Bloomberg Law. I'm Lee Pacquiao. Late last week, Facebook launched its IPO and started trading on the NASDAQ. All did not go according to plan. On Tuesday, a Facebook investor sued NASDAQ on behalf of a class of investors who claimed to have lost money because their orders weren't properly processed on the first day of trading. There are also reports that a Facebook executive lowered earnings expectations for certain analysts during the company's roadshow. Shortly after that story broke, a group of investors filed suit against Morgan Stanley, Goldman Sachs, JP Chase, and other underwriters for misleading them on the IPO. Joining me now to discuss is Robin Farzad. He's a senior writer at Bloomberg Businessweek, and Josh Brown, financial advisor at Fusion Analytics and founder of the Reformed Broker blog. First off, these class actions against the underwriters, it looks bad. This is certainly bad PR. Have you ever seen an underwriter actually get blown up for mispricing an IPO ever? I tried to think about it.
Is the suit, well, so here's the question. Is the suit about the fact that it was a mispriced IPO?
Well, it was about information that was
All right, so these are two different things.
Yeah.
I think that maybe this is a violation of a quiet period of some sort. It's not Reg FD. So Reg FD really only applies to public companies. You could make the case that the selective dissemination really occurred 2 days before the deal happened. So that's a private company at that point. So I don't really know which direction the lawyers will go, but if you read a prospectus, it's pretty thick with risk factors. It almost always exonerates everyone involved. So it's in the early going. I guess anything can happen.
Robin, the SEC said they want to take a look at this. This doesn't look like necessarily a Reg FD issue, but what to make of all this? Is there anything that is potentially going to come out of this, or is this just bad PR?
Well, if precedent is any guide, the SEC is going to act on this sometime in 2018. Look, they say it about 911, but Reg FD is a joke in this town. Reg FD was instituted, I think, during the late 1990s bull market.
August 2000.
August 2000, I mean, at the tail end of a bull market where analysts and certain players in the insider community and executives knew that they could selectively disseminate information. There was all this body language at investor conferences, wink, wink, you know, the sell side talk. We really haven't had a chance to go back and stress test some of the Spitzer era reforms on underwriting and malfeasance. They're now 10, 12 years old, and suddenly you get a blockbuster IPO like this, and I feel like the bankers and the participants, I mean, I don't know how old Mark Zuckerberg was during internet bubble number one, to coach his executives and say, look, you should not be doing this. You should not selectively give information. And you know what? It's a kind of malfeasance that pays for a select few, and it's not going to get pursued. It's vexingly difficult to prove because, as you guys talk, there are pages of boilerplate in the IPO prospectus.
Well, I think what shouldn't get lost here is that Reg FD, while everyone is now accustomed to it and you see them conduct conference calls and they make their safe harbor announcement, everyone kind of abides by it, and it's really not been an area that the regulators have pursued. There have only been about 12 or so either enforcement or administrative actions taken, you know, in the name of Reg D. There were some big high-profile ones like at Siebel and a couple of other companies, but really it's not been an area where there's been a lot of... So, A, I don't know if it applies in this case, that particular statute, and B, it doesn't seem like the kind of thing where there's been a lot of success at going after companies for it anyway.
Right.
So I don't really know what angle, again, the lawyers are going to take here and who they're going to find fault with, because there are now a plethora of suits. The NASDAQ's being sued. I expect something to happen to the underwriters any minute. The company Facebook, there's already been a suit. So this, honestly, I would call it a three-ring circus, but I think that would almost be an insult to the Ringling Brothers. This is really getting out of control.
Yeah, talking about the suits that the underwriters are now facing, they were sued earlier today. There's still a perception, whether there's anything legally there, we're still left with the perception at the end of the day that institutional investors had information that individual investors didn't have access to.
Whether it's legal or not is completely removed from the point. There were like 25 retail individual investors left in the stock market, and they've now been trampled on.
He's got a very good point on that. The idea that the IPO world was ever really the province of the retail investors, I don't know where that came from. Maybe some, .com era ads about online allocations, or Hambrecht and Quist, or W.R. Hambrecht, or whatever it was. This is something that Wall Street primarily doles out to its preferred institutional and high net worth clients.
But the optics here are horrible.
The optics are terrible.
Will this force the SEC to do something, or is this just something that has happened before in the past, and then these stories kind of fall off the edge of the table and everyone forgets about it?
The problem with saying this is going to force the SEC to do something is that A, we don't have that many IPOs anymore. B, the IPOs we do have, other than Facebook, no one ever hears about them
right.
or wants anything to do with. And then C, can we say that this is some kind of a systemic thing? I don't know. This just seems like, look, it was very spontaneous. They only had 15 months to plan this IPO. But it just seems like this is one of those rare cases where retail actually wanted to be involved. The company tried to do the right thing, in my view. They said, hey, open this thing up, get 15 to 20% in the hands of the retail. They did that. But then that last-minute slip where somebody from Facebook kind of gives the nudge or the nod, as Robin called it, to a handful of analysts. And it's almost like this was too good to be true. It was almost going to be a deal that people were happy with, and then they had to screw it up at the last minute. So does that force a regulator to act at the end of the day? I doubt it.
What about the trading aspect of this? NASDAQ is in all sorts of trouble now because they allegedly screwed up technical aspects of the first day of trading. Certain orders didn't get filled. They didn't give notification to customers that their orders were filled or not filled. They've already been sued by one investor for what happened back on Friday. Is that going to go anywhere?
It's tough because it's an overvalued IPO to begin with. So you have to make the case that the fact that the NASDAQ delayed orders or delayed reporting on orders had something to do with the fact that this thing dropped 26% within it. You know, that'll be the argument that, hey, this thing would have dropped anyway. Look how overvalued it was. It has nothing to do with the NASDAQ systems. Only someone that's truly not been paying attention is surprised at all that there were trading snafus that involved high-frequency trading, institutions backing away from bids. You have to have been living in a cave to be shocked by any of what's going on.
You know,
right now.
I'm told by some of the gray hairs that in market history there used to be people that would shout on the floor of the stock exchange and actually provide for an orderly market. I mean, could you imagine when computers could do that? So I wonder what kind of case this makes for that.
This reminds me of the Bats kerfuffle. Obviously, different situation, different. That was, Bats was an exchange.
You just said kerfuffle.
IPO.
You said plethora before.
Well, he brought up the old timers, so I thought I'd bring out an archaic term.
I mean, this is like Bats. Bats is much worse. Short term, this one probably has much longer lasting ramifications because Bats, they pulled it the same day.
Right.
This thing is now sitting here lingering with us.
Point being, at the end of the day, two major IPOs coming out and having major trading issues in the last 2 or 3 months. I don't remember this being a problem before. Maybe I just wasn't paying attention before, but it feels like something's not quite right here.
It feels like less and less emphasis is being put on human touch, human instinct, the white glove effect where, things can actually be orchestrated by a person who's thinking. And when you let computers take over everything, humans aren't perfect. Computers also are not perfect. They're programmed to do certain things, but there is no rationality involved. There's just the cold, hard logic of whatever the circuits and the software tell them to do. So I think if there were more human touch involved with this, it might have gone a little bit more smoothly. The humans didn't get involved until after.
Was this potentially a vast conspiracy organized by some of the underlings at J.P. Morgan to detract attention away from
Probably not.
that, which was the story of the week last week?
Probably not.
It helps them, though, certainly. So looking back at the Facebook situation, we have the NASDAQ issue, the roadshow issue. Things didn't go great here at the end of the day. What does this say?
It just didn't go that well.
Didn't go that well. Understatement of the year. What does this say about the way IPOs are conducted in America in 2012? Anything, or is this just something that got screwed up in this IPO?
Let's be very honest. The company would have done itself a huge favor had they done a Dutch auction like Google did. They may not have gotten a $100 billion initial print, but
not this black eye.
What good was that anyway? I think if you look at a deal like this where there's so much interest, why not have the buyers set the price and remove the whispering people a little bit further from the equation? Why not make it a little bit more democratic and a little bit more reasonable?
And you know what? And when hot IPOs exist and they work, it's Wall Street firing on all cylinders. You make your clients happy. The clients pad their trading commissions and everything leading up to the event. You get more high net worth individuals to advise. The firm suddenly loves you. It's kind of the platonic idea for Wall Street, and you don't have to resort to kind of rolling subprime falafel. And sadly, that there was this great chance to do that. So much so that Morgan Stanley and JP Morgan and Goldman Sachs took a big discount on the traditional fee that they take. And to see it kind of turn around and blow up in their face shows that they really, they didn't traffic cop kind of the priorities of one client or a potential client against another.
All right, gentlemen, thanks so much for coming in. I think we'll be talking about this for a long time. And
let's hope so.
Right, we haven't talked about Facebook enough this month. Thanks, guys. That's Robin Farzad, senior writer at Bloomberg Businessweek, and Josh Brown from Fusion Analytics. If you'd like to learn more about the cases and issues we just discussed, be sure to check out our offerings on BloombergLaw.com and also on the Bloomberg Terminal. You can see more of our videos on YouTube and follow our updates on Twitter. I'm Lee Pacquiao. Thanks for watching.